I want to start with what's going on in gilt markets, because since September, we seem to have been pulling back our expectations for how many rate cuts we get from the Bank of England, in keeping perhaps to some degree with the Fed conversation as well. But the Bank of England maybe didn't like that too much, and we've got some pushback, some dovishness from the BOE yesterday. Was that interpretation correct? And is that going to stick with markets?
Morning, Anna. I don't know if it's going to stick with the markets for the simple reason. The markets are worried about one thing pertinently, which is inflation. The inflation bogey is running amok in the markets, and nothing that the BOE is signaling seems to have had any effect. We saw the dovish tilt yesterday from the Bank of England. We got 3 members opting for a rate cut, and Bailey also reiterated his message for gradual rate cuts, i.e. for the earlier guidance that he had given for 2025. But look at the reaction in gilts. Gilts have gone nowhere, and yields have surged in the past month. Why is that so? Why are the markets reluctant to buy the BOE story? If you look at the 2-year inflation break-evens, the message is right there. The 2-year inflation break-even is at 325. So the market's estimate, the best estimate of inflation, is that it's going to overshoot 3%. And if you add on a neutral rate of 1 to 125 basis points, you will get a BOE rate of 425 to 475, which is why the markets are refusing to price more than 2 rate cuts. And that is going to hold back any rally in gilts, which is why the short-term outlook for gilts is not very constructive.
Ben, let's look at the U.S. Treasury market as well, of course, in the context of the news we got this morning that a federal deficit is looming, a federal shutdown is looming. What does that do to the Treasury market? Give us a floor, give us a yield ceiling.
Well, if you look at, we have seen this movie play out before, Kriti, in 2018, 2019. The markets were shut between December 22 and January 18th, I think, if my memory serves right. And during that period, 2-year yields nudged lower by 5 basis points. 10-year yields did similar as well. So, look, this is a shutdown as opposed to a debt ceiling impasse. So I don't think there's going to be undue turbulence in the market. But of course, one has to keep in mind the thin liquidity that prevails during the year end. But looking beyond that is the outlook for treasuries. If you look at the neutral rate that the Fed has penciled in, they've successively raised that neutral rate, mind you, and they have now penciled in a rate of 1%. Now, Fed speakers have suggested that this may be as high as 260 basis points. That's phenomenal. That's just the real neutral rate. And if you add the core PCE of 270, today we are going to get that number that is expected to show 290. What you get is a Fed funds rate well above 4%, and which is why the 10-year Treasury yield is also sticking above stubbornly around 450. Kriti?